And from there, we can discuss why in this case people treat Forex, and how you can actually plan your trades for using this FX CFD to place your trades. And from there, we'll then talk about things basically your psychology on how you can have the correct state of mind when doing trading in this case. And also we just share a little bit about poems on what kind of supporting tools you can have when you are doing Forex trading while using while using Phillip CFD in this case. Okay, so CFD, which people mention, is actually known as a contract for differences. So what it does is that it's actually forming a contract between the CFD provider, which is us, for this case, which is Phillip itself. We will actually provide this contract with you such that you actually allows you to speculate on the future price movement of the underlying asset without actually owning what is basically the underlying asset itself. So in this case, any price movement itself, right, will actually translate into a profit and loss based on the differences between the price that you actually enter as well as the current price of the asset that you have. So as an illustration in this case, we can take one example of a product, maybe a stock in this case, like with a share price of $1. So when you actually enter a position, you actually make a contract to enter at the price of $1. And if the price moves up by about 110, you make a profit of 10 cents, and you move down to 90 cents. In this case, you actually make a loss of 10 cents. So in essence, you only either get the difference of the if the share price went up to 110, you actually get the basically the profit of 10 cents, which we pay to you. And if on the other hand, if your share price actually goes down to 90 cents, then that's when you have to pay us the 10 cents, which is just settling the difference. We are actually involving the transfer of the underlying share in this case. So why do people trade CFD? Okay, some of the reasons they have is such that number one, it allows you to perform short selling of the underlying counter. So it can be in this case we are going to talk about Forex. So in this case it can also be in terms of the contract itself for CFD. You can actually take a short position, meaning that for normal counters, if you look in stocks itself, right, usually can go long only. But for shares, for this CFD itself, right, you can actually perform this thing called short selling in this case. That means you're taking a short position, meaning selling first at a high price and making profit by buying back at a lower price. Also, CFDs allow you to conduct leverage, meaning that you can actually, with example, with a small amount of money, example like $1,000, if your leverage is about 10 times, right, you can actually use it to gain your exposure to $10,000 worth of the contract value. So this allows you to magnify your gains, but also likewise magnify your losses. So it's actually a double-edged sword which you can use to employ in case you have a strategy that you think is going to be more profitable. Thirdly, in terms of accessibility, right, CFDs allows you to trade in general, right, allow to trade 5,000 counters over 9 different markets that we provide in this case in poems. So just an illustration about the leverage effect. So suppose that so in this case, we just going to talk about what CFD about. So usually we have to talk about the leverage that we have. So likewise, in this case, if you take a position, just an example, if you have a share that's about $10,000 at $1 in this case, and assuming that we only allow you to take about 1/5 of the position, which is 20% of the margin requirements. Assuming you take this position itself, if the share price subsequently, a few weeks later, it goes up to 10%, right? The new price will be at $1.10, and you can realize the profit at $1,000, which is 50% of what you made when you achieve 50% of what you put in your capital layout, which is $2,000. Likewise, if the share price goes down 10% in this case, then because of the magnifying this leverage effect, it actually magnifies your loss to to $1,000, which is actually 50% of what you place in. Okay. On the other hand, if you actually take the short position in this case, if the requirement itself is about that allows you to know about 10% in this case, meaning that you can trade up to 10 times the exposure itself. If the share price move accordingly, like up 2% in either way in this case, you will realize that your losses in this case will actually be magnified about 10 times as well, which is for the share price that goes upwards, because it's against your short position, you will make a 20% loss, whereas if the shares goes down, That means to your benefit, it actually goes up to 20% gain. That's for taking a short position. So in this case, gains and losses are actually magnified when you actually use CFD in this case. So in terms of in Poems itself, right, we actually offer quite a lot of different products for CFD in this case. So usually people when talk of CFD, they will usually go into indices as well as equities. So equities also known as stocks. That means you look into individual counters to actually access to their stock stuff. So share CFD will be what we usually offer to people that you can actually have exposure into Hong Kong and as well to the US in this case. So work indices will be more on trading into our various indices in this case. So you're actually be participating in the price movement of basically the index that's being reflected from there. For commodities over in CFD, we actually check silver and gold. In this case, this kind of CFD. And today's the main topic that we're going to talk about is actually about this FX CFD, whereby you gain exposure to the Forex market using CFD. So what is Forex when we actually keep talking about Forex in this case? So it's actually a abbreviation of foreign exchange. So it's a place where people, participants actually come in to trade in currencies. And in this case, basically there will be buyers and sellers will be quoting each of the currencies. And if anyone is actually agreeable to it, they will actually, form a contract, on a certain exchange rate before they actually make a transaction of the swapping of the two currencies. So this is actually traded over the counter instead of centralized exchange. So next I'm going to explain what is over the counter and what's the difference between the two. So for centralized, what it means is that you have basically one single location, like a single market itself, whereby all the transactions will be done in a single place. So one example will be the stock exchange, whereby one single exchange will actually be used to to trade basically your stocks, whereby buyers and sellers will actually come in together, queue, and actually form contracts between one another to buy and sell. But however, if you look into the OTC, which is a decentralized market itself, in this case, you don't have basically one single place itself whereby people can actually buy and sell and have visibility on the place to trade. So in essence, what we have is that trading is basically you just deal directly with the dealers in this case. So one bank or one participant can actually go into basically the dealer say that I wish to sell, for example, like basically euros to exchange for USD. So this dealer will actually place an order through a system itself whereby they route to all the different brokers and dealers to say that they give you a quote. So in this case, the other dealers and brokers, even the bank itself, will check to see whether they have any other counterparty who wish to do the opposite, which is to trade basically to get their USD to actually to buy the euro dollars in this case. So it's the opposite side of the trade. So once they have, they will match it together, and that's when we call the trade that's being executed either through a system which is electronically or offline, which is done through the phone itself. So a bit of FX terminology, how do people actually use to quote the terms itself. So usually for FX, it's actually quoted in pairs, which is called a currency pair in this case. So they are actually valued relative to another currency. So to look into this, we take one example with this Euro USD. So in this case, this Euro USD, that means when you actually quote this currency, they give you the number, example like 1.08196, right? What it means is that the price of $1 is valued at how much of the USD in this case. So to take into perspective, if we give a formal definition in this case, right, the euro, right, will be considered as the base currency, and the USD, which is after the slash in this case, is actually called the quoted currency. So when you look at the price, it's actually the price of the base currency, in this case the euro, quoted in basically priced in terms of the quoted currency, which is the USD. Yeah, so this is what we can how we interpret this FX. Next, we have this term called the Peep, which is PIP. We call it. It's actually a unit of the fourth decimal place of the currency pair. So in this case, usually for major markets, we actually use the code date on the fourth decimal in this case. But for Japanese yen, because of the currency itself, we actually code it as the second decimal of the pair itself. So what this illustration in this case is actually based on the USD HGD. So in this case, when we select the PIP itself, it's actually, you count it based on the decimal place, would be actually on the fourth decimal place in this case. Likewise, for quotation itself, we have the direct quote and the indirect quote. So direct quote will be, in this case, we actually take relatively in basically on the location and also what's the major currencies that is being traded at the place itself. So formal definition for direct quote is actually the quote of the basically fixed amount of foreign currencies, like 1 unit in basically based on the domestic currency quantities in this case. So usually, if you look in international markets, like their domestic currency is sort of, we actually use it as USD because USD is actually our reserve currency. So if you go to those overseas websites itself, they usually do a direct quote in terms of USD in this case. Yeah. So basically, the direct quote in this case, the quoted currency is in USD. Then indirect quote means you do the reverse, meaning that the base currency, the position itself is being used as the main quoted currency. So if I want to explain, the quote of fixed amount of domestic currency, 1 unit in the foreign currency quantities in this case. So to give an example, in HE itself, right, the domestic currency is HGD. So if we take the location in this case in Singapore itself, right, usually you look at Channel News Asia, the direct quote will be USD/SGD. So you see the number usually at $1.40, $1.39, etc. But if you actually do the indirect quote, basically, for example, in the other markets, international trading houses, right, they will usually base it on USD. So you look at their countries, in this case, it will be like SGD/USD. Then it will be in the reciprocal of the price itself, which is the indirect quote. Yeah. Okay, so the next terminology people use, right, for those direct quote, indirect quote, we also be this thing called the cross currency pair. So cross currency pair usually will mean that that is actually the pairs that does not involve the USD, which is our reserve currency. So this involve like SGD against Malaysian ringgit. So this is our favorite currency when we always go to the JB to actually to use their to actually go for their services. So this is actually some of the currencies that we call it a cross currency pair. Likewise, you have also the popular ones such as the Euro GBP. So this is basically the currency base. I know €1 as compared to how many British pound to be paid for. And then we also have this CNY to JPY. So this is renminbi to Japanese yen, etc. One thing to take note is that spreads are usually wider for cross pairs in this case because of liquidity in this case, meaning that the number of people, like the number of buyers and sellers within for this currency pairs. So usually the major currencies are something that's involved the USD and euros or Japanese yen will have basically a smaller spread as compared to the other currencies that we have. So this is something to take note. So this is also a screenshot of the major currency pairs that we have in Forex. So if we are looking for something we want to trade that's quite liquid in this case, usually people go for these 7 pairs in this case. So the top one in this case are usually Euro USD. That's one of the most famous one. Then if you're looking for safe haven kind of trading strategy, like people usually anything that if there's anything that that people are spooked out of certain economic news, usually basically the funds will go to the Japanese yen. Then you have this USD JPY that people use. Others include, you can see over there, you have the New Zealand dollar USD as well as the USD and the Swiss francs, etc. So why do people trade Forex in this case? Okay, the reason being is because Forex in this case, it allows you to trade 24 hours, 5 days a week, meaning from Monday to Friday itself, you can trade continuously without stop until when until the start of the basically in the start of this the 5 a.m. of the weekend itself. Usually it's a Saturday. That's when the it actually start trading from there. Then when you actually want to continue trade to start your trade, in this case, it will be reflected in the 5 a.m. of the Monday morning. So that's when you can actually start trading from there. Another thing to take note is actually the zero commission. So basically, when you actually enter a position itself, right, you won't be there won't be additional cost in entering a position in this case. Likewise, for forex trading, you can actually go bi-directional, because that if you actually long one currency, right, because due to the currency pair, you actually indirectly shorting the other currency. So one example would be the euro USD in this case. If you think that the euro itself will appreciate against SGD, then in this case you will actually long this contract of euro dollars, but in essence you are also taking a short position of USD as relative to the euro dollars. So in this case, if you think opposite, you can actually do the reverse by longing the USD and shorting the euro dollars. So it's actually bi-directional. High liquidity, in terms of liquidity wise, right, the number of trades done, right, is actually much, this market is actually much wider than the stock exchange in this case. So if you actually look in the Go and Wiki in this scale, you can see that actually the forex market is the largest financial market, and it's not as not the stock market, which is quite popular in the news in this case. So this is something to take note. There's also leverage component in forex, because usually in this case, when you look in the sizes itself, right, in the major markets for forex trading, it's usually done in sizes of 100,000 or even more for a normal contract. So that's why usually, I mean, for a retailer don't have no one shot have 100,000 to trade. So in this case, you can actually utilize leverage, in Singapore up to 20 times or 5%, right, to actually to enter into a position, which means that for 100,000 in this case, you can actually just place in about $5,000, then you can actually enter a position from there already. Yeah. Also, it's a free platform to use when you actually trade forex. In this case, that means there's no ongoing fees, platform fee. And also one thing is that people can no longer corner the market because usually currencies are actually determined by by the government itself, and there's no one single party who will buy up all the currencies and try to influence the market. Okay, so now we talk about just now we talked about CFD and we talked about forex. So if we combine both together, we have this thing called the FX CFD. So what is it all about? So in essence, they are actually contracts that allow you to gain exposure to the underlying spot pairs, in this case using CFD. So some details that we have for this FX CFD is whereby they are actually in sizes of 10,000, which is actually 1/10 of the size of the normal forex contract. People, if you actually have those traded CFD before, I'm sorry, my bad. If you have traded forex before, is equivalent to a size of a mini contract in this case. We don't charge commission when using FX CFD, meaning that you only buy through the B and R's. In this case, the B and R's in this case. Likewise, trading hours will be actually from Monday 5 a.m. all the way to Saturday 5 a.m. So continuous non-stop trading for 5 days a week. And this is just to let you know, there will also be like daylight saving mode as well as non-daylight saving mode. So this is something you may want to take note. As of now, if I'm not wrong, it should be under the daylight saving mode right now. So actually market starts earlier, so we will be looking at the 5 a.m. timing. Yeah, and also each Peep itself will be actually based on the pricing of $1 in this case. And likewise, the margin requirements, we are actually following the MAS rule, which is starts from up to the minimum margin requirements is at 5%. So this is what we're offering at 5%, meaning your leverage can actually go up to 20 times. Okay, just something to let you know. Recently, we actually launched our this New Zealand dollar pairs in this case. So actually, right now we have up to I think can be actually be up to 30, more than 30 in this case, more than 30 pairs currently. So just to let you know, for some of our more, you can actually go to our this PhillipCapital CFD website to find out more our offerings in this case. But to let you know, our competitive FX pairs in this case are usually our major currencies as well as our USD, SGD. So you can see that actually at the the pips in this case is actually on average, right? In this case, we have shown you is about 0.7 to 0.9. This is our rates that we have. Our latest, in this case, FX pair, in this case, I mean, you can see below is not only just this, but also the New Zealand pairs. That's what our latest offering. So feel free to go to our website or even to our Points platform to to look at our latest pairs and you decide for yourself whether it's competitive or not. So why do people trade FX CFD? Okay, number one, there's no commission and finance charges. Number two, just now we mentioned, sorry, my bad. No commission and finance charges because in this case, you are only paying for the bid and ask in this case. So basically, we don't charge you for holding the position, intraday. We don't charge you any financing charges. There's no commission in the position. Number two, if you want to enter a position and you are afraid of suddenly the market goes against you, right? Then what should you do in this case? So not to worry about that. We have stop limit orders such that if the position goes against you, at least you can actually limit your losses by implementing a stop limit order. Or likewise, if you want to do some breakout strategies, you can actually use our stop limit orders to do so as well. Spreads are competitive. As I said, you can actually check on the website or in our Points platform, see for yourself, and compare with basically our competitors to see how competitive our spread. Likewise, if you are for 24 hours, 5 days a week, if you are feeling basically you can't sleep at night itself, around 3 to 4 a.m., feel free to you can just implement your strategies of FX CFD. You can do so. You don't need to actually to have a separate CFD account to access this on FX CFD. So all you have to do is you have basically a CFD account that's open. You can just place your funds in and you can trade from there. And likewise, there's no maintenance fee and account opening fee for using this FX CFD feature in this case. And so in essence, also just by opening CFD account, there's no maintenance fee in maintaining this account itself. So how to actually people trade in this case, which I mentioned, you can actually have, we only does it through bid and ask in this case. So you see on the screen over here, we have this platform whereby if you want to enter a position directly, right, you can actually submit an order. Example, you want to long euro, right? You can just click the button buy to actually purchase this contract at this price. You can see it's 1.08051. Or likewise, if you want to take a long position in USD against euro, right, you will select the sell action, which is to sell at basically to do it immediately at a bid price, which is 1.08043. Yeah. So the order types currently we have is actually limit and stop limit orders, which are in future we will be adding more basically the order types to actually to allow you to actually to have more flexibility in your strategies. So just to let you know how this FX CFD actually works. So in essence, if we take this first example, which is a longing a contract. So in this case, you just want to buy want to long this USD against SGD, meaning that you think that USD will actually appreciate against SGD. So in this case, you buy 10 contracts of it, which actually value at 140,000. Assuming that you enter at $1.40, and based on our margin requirement of 5%, this means that you just have to put in $7 Sing dollars for you to enter this position. So if we actually take into account basically the different scenarios, if on one hand in your analysis is correct, the USD actually appreciate against SGD, then your contract value will actually be now at 142,000, and also this means that your profit will be gained at $2,000. Yeah. So whereas on the other hand, if you actually your USD actually depreciates against SGD, meaning SGD grows stronger, you may actually also have a loss of $2,000 as a result of basically the market moving against you. So this is something to take note, that your gains and loss may magnify. But likewise, if you do your homework correctly, it can be actually quite a profitable avenue for you to actually to make a gain in this case. Likewise, if we actually decide to do a short contract, that means you're going to take a short position in this case. For example, for Euro USD, you're quite bullish about USD as relative to euros in this case. then you, in this case, you will short, we can sell off 10 contracts of it. So in this case, 10 contracts with the price of $1.08, right, means that the contract value will be USD will be $108. I'm sorry, $108,000 in this case. So in this case, you do realize that for the contract values, right, the price of the contracts in this case are actually in the quoted currencies. So in this case, you'll be based on the basically the, in this case, will be on USD itself. So if we actually take 5% of the margin requirements, this will mean that you only take $5,400 of USD to actually to start the position. So by doing the selling of the contract, you are actually longing USD against euro dollars. And based on the scenario for this, we take the first scenario whereby in this case, your position actually, in this case, the markets thinks that the euro dollars will appreciate against USD. So that's when it went against you. And in this case, you made a loss of 2,000 USD. So this will translate to 5.7% loss. But on the other hand, if you are actually right on the money, right, whereby USD, right, sorry, my bad, USD actually appreciates against the euro dollars, or likewise euro depreciates against the USD itself, right? That's when you actually make a gain of 2,000 USD. Yeah, so likewise, all your gains and losses are magnified in this case. So use with prudence if actually using FX CFD. Okay, from time to time, people might ask, if I hold my position beyond 5 a.m. or 6 a.m. in this case, when I hold overnight in this case. So your position will actually gain or lose swap points in this case. So what does this swap points means? So it means it actually refers to the interest rate differentials between the currencies bought and sold. So in this case, if you look at euro dollars and euro USD example, right? Euro dollars are currently basically based on the interest rates, right? May actually be in a negative region, whereas for USD it's actually a positive region. So this will mean that if you hold euros overnight, you actually basically have to pay interest just by holding this position, by getting the negative interest for euro dollars and paying for the interest for the USD side. On the other hand, if you're actually longing USD and shorting euro dollars, your USD itself will actually gain interest rate as compared, and also for euro dollars, by right you should be paying interest rate for holding euro dollars, but because of the negative interest rate, you're actually gaining it as well. So in this case, you're actually gaining an interest rate. So the bottom line is, if you're actually buying the currency itself, right, you earn their interest, and whereas if on the other side of the pair itself, if you're selling the currency, you have to pay the interest for holding a position overnight. Okay, so for this case, other than swap points, another thing to take note is actually the settlements and rollover itself. So just to let you know, for Forex transaction, they are actually valued at this T+2. So T+2 actually is the trade date plus 2 working days. So this will actually be basically the norm for most currencies, except for any currencies that deal with Canadian currencies. So in this case, their settlement for this case will actually be on respective with T+2 as well as T+1 for Canada itself. So what this means, the settlement means that there will be actual currency delivery in this case from basically between the one who actually initiate position and another with the counterparty in this case. So for what we do in this case, because we don't want to prevent any settlement of the trade itself while you actually hold a position in this case, we will do this thing called the rollover, meaning that we are actually basically take a position to actually to sustain your Forex position. We actually do a offsetting position and enter another position such that you can continue to hold your currencies to be to continue to long it in this case. So this will actually be done every day, such that you are able to maintain your currency position and without any intervention by you doing yourself. So we will actually an automatic process on our end. So just to illustrate for that, right, this will have an impact when you actually try to hold it overnight. So so in this case, when you actually start it on Monday itself, right, basically T+2 will actually be on the value date on Wednesday. So the rollover will be conducted basically on each of the day itself, in between in this case. So on you, if you do it on the trade day of today, example today is Monday. So basically, if I want to continue holding more than 1 day itself, right, then that will entail a rollover to Tuesday itself. So in this case, the rollover will be conducted. Then the next day, if you close it, right, basically the value date will actually be on the Thursday itself, etc. So the key thing to take note is that on Thursday itself, right, the rollover date will actually be basically the value date, right, will actually be done on Monday itself. We entails 4 days in this case. So this is something to take note when you actually do this kind of Forex. Yeah. Okay, so that's for mostly for FX in this case. Yeah, so right now I'm going to talk about the types of trading strategies when you want to implement your Forex trading in this case, just to share a little bit. So some aspects you want to look for, like when you actually want to plan your trading strategy in this case, right, may entail, you know, deciding what's your trading period in this case, how long you want to actually to hold your position. Likewise, what kind of trading strategy we want to implement during, you know, when you see the whether the currency pair is in a trading a range bound or over a trend in this case. Thirdly, what kind of indicators that you want to use when you actually want to plan, actually, you know, to decide when's the entry and exit point, and also you want to think about your basically what kind of target price and stop loss prices that you want to set for each of these strategy. So this is some areas you may want to look into. So firstly, I will go through about the trading period in this case. So based on your style of trading, right, basically what kind of, you can actually decide how long you want to actually to hold your position in this case. So we have this thing called the day trading, swing trading, and position trading. So depending which one is what kind actually suits your personality, you can actually choose it. So for day trading itself, you're actually trading within the day itself. So this will actually take advantage of short-term volatility, and that means you actually enter position and exit at the same day itself. So this is usually the kind of the chart that you actually use to analyze. Like it's actually 5 to 15 minute charts in this case. But if you don't want to keep staring at the screen every day in this case, I mean that frequently, like every hour you can look, or even every minute you keep looking at a chart, right? You can actually take somewhere in basically the middle ground, which is doing a swing trading. So this will entail, you know, entering a position and exiting, you know, about 2 days or up to 6 weeks in this case. So this usually entails capturing a single move during this period in the market itself. So for example, if you take a long position, you expect, for example, Euro USD to, you know, from $1.05 all the way to $1.08, right? Then in this case, within about 1 week or so, so this, what you do is just take a long position, in the contract of Euro USD, and subsequently closing it about 1 week later, when the Euro or USD actually really went up, you know, $1.08 or near that now. So that is something that you may actually consider if you actually more prefer to have this kind of time period. So the price chart usually you use is actually between 1 to 4 hours, one hour or 4 hour chart in this case. If you are actually more of the taking a longer term view, right, you can actually always choose a position trading, meaning in this case you enter a position and will hold the position for months, in this case weeks or months, such that when you reach your target, right, after based on the analysis itself, right, or basically based on the currency fundamentals, or in this case such as the interest rate, or even the trading policies of each of the countries itself, then that's when you actually do such a trade in this case. So in this case, you are not very concerned about the short-term fluctuation, and you're actually taking a more on the long-term view. For that, you will be more inclined to use a day chart in this case. So to compare the basically the pros and cons for each of the trading strategy in this case, for positional trading in this case, you're actually taking you're actually holding the period, which is basically my bet is actually holding period is actually between 6 weeks or to 9 months or more. So in this case, it's actually you're taking a minimum time and effort for trading itself, and this have a more favorable risk to reward ratio for you. But likewise, if you are holding such a long period of time, right, it requires you to understand basically the fundamentals of the underlying currencies in this case. And usually by holding that longer period, right, you will actually require a larger sum of capital, just in case the market moves against you. Then there's any those margin call in this case. At least you have a buffer for you to do so. If you are more of those person who are doing swing trading, right? Okay, so sorry, I'm bad. Let me just adjust it so that it's actually more accurate. Okay, much better. So if you are more of the day trading, those people who actually trade, basically does a trade, does a trade basically entering and closing within the same day itself. You can actually use this day trading. The good part about it is there's no overnight risk. That means you no need to wait, wait for the basically the swap, basically the what call that, the what's called. You don't have to wait for the swap points in this case to actually to adjust your returns, basically your entry position, and also you can start off with a much smaller capital. But however, this will require you to monitor the stock, basically the charts, as well as the price action of the position they are taking, also of the currency pairs they are trading. So this will require more time and effort on your part. So if you're doing day trading, it's actually quite basically quite a strenuous activity to do so. For doing swing trading, that means taking in between the basically the position trading and the day trading itself. Likewise, you no need to have any basically you take less time and effort to do this kind of swing trading as compared to day trading, which is also in terms of capital wise, you're actually taking a smaller capital as compared to position trading in this case. But however, there will be always have this overnight risk, whereby if you hold the position over time, right, the swap points will actually gradually, if is basically your interest is working with you, then in this case you'll be basically on basically it will actually have a favorable position for you to hold overnight. But if you actually you actually long a position which requires you to pay the interest differential over time, right, then that's when you add up to your cost of maintaining the position in this case. And also because of the duration in this case, it will also require you to actually to understand a little bit of the basically how the currency fundamentals actually work. So this is something you also need to take note. Likewise, after considering the time period that you wish to trade, right, then the next section that you want to think about when planning your strategy is whether you want to implement this strategy on a range trading market, or in this case on a trend trading market for the currency pairs. So for range trading or currency pairs, right, it's actually when you actually use this trading strategy for a range market, it's actually implementing the strategy whereby your prices for this case the currency pairs actually move between a higher bound and a lower bound price regions. So in this case, we call it as a resistance and support, or support resistance, whichever way you want to call it. So in this case, when you actually use this range trading strategy, right, take note if there's any price breakout beyond this support and resistance in this case, right, it means it signals you that they may actually basically the prices for these currency pairs may actually move towards the next basically the trend trading in this case. That means the share price maybe start to move maybe in the higher direction, which is an uptrend, or in the lower direction, which is a downtrend. So while using trend trading strategy in this case, it will actually be quite different as compared to using a range bound trading strategy, because in this case your strategy will be slightly different. So if you're, for example, you're using a trend trading strategy, right, you are actually longing a position, and expecting the share price to go higher and higher. But if you actually use basically a range bound kind of trading strategy, right, which is when if the share price hits a certain basically the price basically higher price like a resistance point, then you sell off the position, right? then you actually miss out on basically the higher upside of your higher upside when actually the currency pair moves higher and higher. Likewise, if you're actually using a trend trading strategy on range bound currency situation right now, right? Then you have a lot of this thing called the whipsaws, whereby your share price will, if you determine that it's going to move upwards in this case, but however, because of the current price move action, which is trading between basically support resistance, right? It will allows you, in this case, you may have a lot of those forced entry and actually the exit positions. That's such that you may actually have an ineffective strategy as compared to using the right strategy in this case. So for trend trading strategy, look out for changes in the higher highs and higher lows for uptrend, and for downtrend is usually look at the lower highs of the share prices as well as lower lows for the downtrend in this case, lower highs, lower lows. So one example in this case will be the USD Japanese yen. So if you actually look at the green line and the red line, right? So if you are doing a range bound kind of strategy in this case, right? Usually you will expect the share price to be moving at this two region in this case. So I will actually, enter a position where if the Japanese, basically this contract itself, right, is actually touching this price of 106.164 and exiting in position when the price is actually at 104.7 sorry, 109.7 in this case. But however, if I'm doing a range, basically the trend strategy in this case, I will actually be, going long and actually be maintaining a position as determined by the gray kind of basically the channel that actually drawn in this case until when basically the bottom line is being violated, which happens towards the end itself after the double top kind of signal in this case. Sorry, my bad. When actually the first top in this case actually breaks down the lower channel itself, that's when I will exit my position. So in this case, you do realize that the kind of strategy when you implement trend bound and range bound, right, is actually quite different and may result in basically losses if you actually use it with the kind of strategy that you use is actually not in basically in the same sync as the current price action of your counters. So after talking about the price action, which is either range bound or trend bound in this case, we will look into basically the type of technical indicators. So usually for the technical indicators, right, in general, if you look at technical analysis itself, they have various tools. So for the tools itself, you can have usually the price trends and the chart patterns that usually people look for chartists in this case. They also look into support and resistance in when actually doing the chart for price charts in this case. So when you look at indicators, we usually look into overlays as well as oscillators. So just to give you a definition for technical indicators, what are they about? So they're actually based on a series of data points derived from the application of basically the kind of price data they have that happens during that time period in this case. So they can be, in terms in general, can be OHLC, which is open, high, low, and closing prices respectively. If you're dealing with stocks or dealing with like commodities in this case, futures, right, they have the volume in this case. For Forex in this case, they actually look more into the price in this case. Yeah. So moving averages in this for how they actually determine basically for price action, right? They can actually be calculated based on the day open, close, high and low prices, etc. So the objective of using technical indicators in this case is actually for you to alert any potential price action that warrants further investigation of the currency pair, to confirm whether other technical tools that they use, like example like charting, like all those price patterns such as double tops, triple, basically the heads and shoulders, inverse heads and shoulders, etc. So this is actually to confirm any breakouts for the share price upwards or breakdowns downwards, and also to potentially predict any future price movement that could happen along the as the time goes. So for technical indicators, we have two kinds. So we have first one, the leading indicators, whereby it's designed for you to know, to actually to allow you to check whether it's basically for you to do a little bit of forecasting, whereby you actually try to to see whether future price movement itself give you a glimpse whether there's higher chance of the share price moving upwards or downwards, etc. So this allows you to get allow you to have the to get you in a position profitable position earlier, though it is usually less reliable as compared to the lagging indicators. So lagging indicators itself is actually used to confirm either the trend basically or the momentum that the share price actually move. This one will actually have higher reliability with although we have a slower signaling in this case, because its main purpose is to actually to confirm whether the trend is moving upwards or downwards, etc. So if you actually just use lagging indicators, right, yeah, it may actually lead to basically lower profitability when using such strategies as compared to using leading indicators. However, in terms of reliability wise, right, lagging indicators have higher reliability. So when you actually use them by itself, right, it's actually a trade-off between the speed and reliability. So for the indicators itself, right, when evaluating them, right, you can actually categorize them into trend, momentum, or volatility when actually used for Forex trading. So for trend itself, right, trend indicators tells you the direction of the market. Is it moving upwards or downwards, or in this case, there's no direction, maybe trading sideways or range bound, right? Then the trend indicators will actually show that. On the other hand, we have the momentum indicators, which actually shows you the strength, basically how strong the price, basically the price action is. So in this case, if the stock prices actually move very sharply upwards, right, then the momentum indicators will actually illustrate that by having a very one-sided kind of signal in this case. Whereas if the share price in this case move up to a certain range in this case, but the momentum shows to be getting weaker and weaker, then this can actually tell you that basically the price itself may be due for basically a reversal, or in this case like a sideways kind of trading. In this case, that means they're losing strength. And lastly, we have this thing called the volatility. So this means that it actually shows you the potential of the price of the share price. Basically, I mean not share price, but the price of the asset itself, right, can actually move in a certain direction. That means how wide in this case the price can actually move in either direction. So when you actually use this indicator itself, right, to do your basically implement your trading strategy, right, one way you can use is actually to use this thing called the mean reversion to trend in this case. So what it means is that, for example, if you have some sort of use this indicator called the Bollinger Bands, or in this case the price band in this case. So if the price actually moves basically towards the outer bands in this case, right, then there's a chance that over time itself you eventually return back to the trend line, which is usually by a moving average, which I think you can actually attend to our technical analysis webinars to find out more about how to use these technical indicators. So as an illustration for different kind of basically technical indicators, we have the following. So for trend indicators, our popular ones includes the moving averages and MACD, which is a moving average convergence divergence. So other trend indicators that is quite popular itself is also the parabolic SAR, as well as the Bollinger Bands, which can also be used for volatility purposes. For momentum wise, on the other hand, right, basically the strength of the price action itself, we can use the RSI, which is the relative strength index, or in this case the stochastics, to track whether how basically the strong the price action is in this case. So as you have all these indicators in this case, you can actually mix and match some of them to tell you a fuller picture of how strong is basically the price action, or in this case which direction is moving. But some things to consider when you want to add them, right? in this case, as a guide, there's a yardstick in this case, right? Try not to choose more than 5 indicators in this case, because having too much of such indicators will actually slow down your decision making, especially when the share price is actually moving quite aggressively. So if you have so much, like example, like overlays, in this case, you add a Bollinger Bands, moving averages, or even like the Ichimoku clouds in this case, all these indicators itself, all that will actually, take more time for your brain to actually to process. And when actually during, especially in day trading itself, right, time is of essence. So you wouldn't want all these filters, to actually paralyze your decision making. So it's important to make your charts and also your workspaces easy to read, so that you can actually allow you to have a better, basically a clearer and also a faster way for you to pinpoint the entry and exit points. So this is one example whereby you actually have Ichimoku clouds on it. So this will actually allow you to to see the price chart quite easily. On the other hand, you also have the basically the RSI below. So this is in reference to basically the stock itself for DBS. So for CFD itself, we can also use this kind of charting tools actually to plan your entry and exit points in this case. So if you actually look in this case, right, it seems like it was on the downtrend based on the cloud itself, and the share price actually was broke past for a short-term uptrend before breaking down again. So breaking down is usually a signal that the share price is actually, basically the trend has been reversed, and seems to be a possibility that the price itself may hit down, down in this case. Also, another thing, when you actually add your technical indicators, like example, when you actually want to do your FX CFD itself, right, you wouldn't want to add indicators that give you the same information. So, example, if I want to have a trend indicators, you don't want to have moving averages and MACD in the same page to to illustrate the same information, unless you want to use the MACD itself, like for basically for momentum purposes, like to see how strong is basically the price trend, basically how strong is basically the price action itself. Otherwise, you wouldn't want to add too much details and too much same information to that, because that will actually create redundant signals which can be misleading. And also, on the other hand, it allows your brain to process information which is the same information at the same time, and also eat up your processing time in this case. So that's why if you want to add your signals together, you add complementary indicators such as RSI with moving average, or parabolic SAR with those stochastics kind of indicators, such that they actually complement each other. They show you the direction and how strong it is, and whether the price movement will spike, basically move downwards or upwards, etc. So this is kind of the indicators you want to combine together. So after that, after you consider basically the trading indicators itself, you may want to think about your basically after entry price, then after that your exit price in this case, basically setting your target price and stop losses. So when you actually decide to have your own target price in this entry and stop loss price, right? Do remember to do the back testing of your strategy in this case, whether this strategy actually holds for basically different currency pairs, because something that works for Euro USD may not work in example like Japanese yen SGD in this case. So that will actually affect basically your P&L because of the different nature of the currency pair. And also likewise, if you decide to change your time frame, basically your charting, for example, from 5 minutes to 15 minutes, do a little bit of back test on whether your strategy still work. Also, when setting your target price and stop loss, consider how high you want your target price to be, and how much you want to set your stop loss in terms of percentage. So one way to do so is actually use this thing called the risk reward ratio. So risk reward ratio in this case will be based on the target price and also based on your stop loss price itself. So example, if my entry price is about $1 in this case, I set my target price to be basically like $2, and basically the stop loss price to be like 50 cents in this case, right?
So in this case, my risk reward ratio would be more or less like $1 on top, and below will be about it's about 50 cents. So that will be until we 2:1. Yeah. But however, something to take note in this case, right, when you do reward risk ratio, right, is that if you set the reward, the risky target price very high, right, this will mean that although your each entry point and exit point will allow you, if your strategy actually works, right, allow you have a higher profit in this case, but it also runs the risk, whereby your basically your price actually went up, but however didn't touch the basically your target price in this case, and subsequently if it actually goes on the reverse direction, then that's where you may trigger basically your stop loss price in this case. So this is something you might want to take note if you want to set a very high reward price in this case. Likewise, if you set a lower risk reward ratio in this case, then in this case, that means that you actually close out your positions for basically when the share price actually moves slightly basically higher with a lower target price, right? That means you exit a position early. So this will require you to have this strategy to have a higher success probability as compared, as compared to triggering your stop loss price. Because if your stop loss is actually at a relatively wider range as compared to basically your target price as relative to your entry price itself, then this means that you have basically your losses itself will actually cover more of your basically your profits when that thing actually happen. So that's why you require a higher chance of probability for such a strategy in this case. Okay, so that will be more on the trading, basically for tips for planning your trading strategy. So likewise, for every trader itself, right, other than having a good trading plan, we also need to have the right state of mind when you actually do your trading in this case. So in this case, when people do trading in this case, they will have a few reasons why they actually fail in trading and investment in this case. So some of the reasons when people place basically do their trading in this case, right, may entail the following in this case. So number one, so if you have basically inherent fear of of basically you don't like basically market uncertainty in this case, then in this case you will have that kind of belief that you need to predict the market's next big move in order to make big returns. So this will mean that you don't have a trading strategy. You just want to go in and think that I think that the basically USD will actually appreciate against HCD up to a certain level. Then that will become like a speculation without a proper trading strategy as well as the kind of fundamentals in this case. So when you do that, it's essentially gambling, which is quite risky. Like it's like buying a lottery in this case. Second area of basically the root of why people actually fail in trading will be the essence of greed. So in this case, essence of greed is like when you see your peers making money in the stock market or making money in the Forex, in this case, right? Then you stand out like, have a kind of envy or even like the one that you want to be like them, or that I also want to make more money from there. So once you have a little bit of profits, then in this case, you want to have even more. So that's when you actually go beyond your trading system and do some risk maneuvers. So that will actually entail you having a belief that either you want to take huge risks, like entering a position that's more than what you can handle, so that you want to have a higher profit in this case, or you actually look up for someone else, right, who already make profit from the system itself. So that's when you actually try to buy the system, or try to look into the system and try to replicate from there without knowing how it actually works. So all these can actually, if done incorrectly itself, right, you may actually be suffering a loss. So this is one thing that traders should be actually be wary about. Lastly will be this thing called overconfidence, whereby you actually implement your trading strategy and you want the market to actually to show you that your strategy is correct. That means in essence that you're actually being stubborn in a sense. So example, like you implement your basically your own price. For example, like enter
USD HED at $1.39. Then in this case, I believe that the USD will appreciate to 140. So I actually enter a long position without the idea of having a stop loss, because in this case, I had it right in my mind and said that I know the market will allow me to have this position, to go to $1.40. But however, if in this case, maybe due to some market conditions itself, right, the price of USD actually went down to 138. But because of your side that your belief that you have to go to 140 and keep holding on, then you keep going lower and lower, then margin cost start coming up. That's when it's easy for you to lose how much that you can actually put in the market itself. So this is also one kind of sin that investors will have to, not investors, traders itself would need to be worried about, which is overconfidence. So how to actually form the right mentality in your investment or trading itself, right? One thing to take note is whenever you do your trade itself, right? Key thing is to either write down or take note of how you felt during each stage when you actually enter your position in this case, and what kind of strategy when you cut loss or you take profit, how you feel. You actually reflect onto it and consider whether is it the right thing to do it for this case. So after you think through the process itself, right, then you do a post-mortem assessment to see whether how you can actually do it better, and from there you can actually tweak your trading plan. So the key thing is to identify your own behavior, your mood in this case, whether it's interfering with your your objective kind of mechanical kind of investment strategy. Yeah. So digging further into right down to your core, right? Basically, when you are doing trading itself, you need to find your purpose and motivation. Why do you want to do Forex trading in this case? To make money, okay. But what is your you want to find yourself, what is your niche in this case? Which currency pair you think that you are actually strong in? So in this case, if you actually you realize after backtesting and also due to after a few actual trades, you need to have a few trades to gauge a few like what kind of trading pairs are actually they're actually more confident in, right? That's when you actually get focused on the currency pair and also on any of the news and also the country's fundamentals when you actually trade for this kind of currency pair. So in this case, you actually form your own circle of competence, like how you can actually trade based on this currency pair in this case. So by actually attaining this unconscious competence, right? So what you do is that for the start, when people start out, they have this thing called unconscious incompetence. So meaning that you don't know what you don't know about. So basically, you are just quite blur in this case. So when you actually try it out, right, then you become conscious of your incompetence, which is you know what you don't know. That's when you can start the learning process, right? Whereby where you need to which areas you need improvement, and that's when you do a step-by-step improvement. Then you make it conscious of to learn how to make a profitable trade. So once you actually learn how to do it, then you start practicing it. But in this case, you have to take time. Usually, it will take time to actually to form out your strategies. So that's when you have actually achieved this thing called the conscious competence, meaning that you have to make effort, mental effort to actually to do the steps in order for you to place a trade. And over time, usually after there's a yardstick, people say that after 10,000 hours is actually the average time that people actually use to actually make themselves to have this thing kind of mastery, right? So when you actually reach this thing called mastery, that means that you don't need to spend so much time, 1 to 2 hours, to review whether a position is worth taking or not. So in this case, when you look at the chart, the tools and all things actually come automatic to you within 5 to 10 minutes. You know when to actually to set your entry and exit positions from them. That's when you actually attain this thing called unconscious competence. So this is basically a process for you to actually to find out what's your trading strategy and what kind of currency pairs you need to go into and how you actually practice it such that you become quite competent and quite fluent in your trading methodology. Yeah. So
what analysis method and as well as investment instrument will actually suit your personal personality. That's also one thing you might want to think. So a complete investment system will actually entail what to buy, when to buy, what price you want to enter, and when to sell, which is your target price and your basically your stop loss prices. How much leverage to use, which is basically based on the FX CFD that we have, you can do up to 5% in this case. And if you actually make a mistake, how you're going to do it? Cut loss already, then how you're going to tweak your investment, your trading system in this case, and what to do if your system does not work, etc. Yeah. If you have no time to create your own system, right, then you might want to find someone else to help you to basically have such investment system and have a track record in getting the returns, right. Let them do the work for you. In this case, that means you don't per se. That means you don't buy their system or how to do it, but rather you actually based on the track record, and if they have all these systems on how to invest, right, then you let them basically work out their investments or their trading skills in this case. So something to share with you. This is for traders itself. This will also apply as well. So key thing to have is unconscious competence. Basically having a clear trading method as well as know when to sell. So in this case, we have these two key investors who actually managed to do that. For George Soros, he also did a few trades, which is basically by betting against the sterling pound in this case. So he was famous in the early 1990s for breaking the Bank of England itself. So this is some of the methodology, kind of the thought process that you should have when you actually approach trading as well as investment in this case. So if you have the time, right, you can actually look into this book by Mark Thier, which is the winning investment habits of Warren Buffett and George Soros. So this will allow you to cultivate the kind of mentality for you to approach investing as well as trading, so that you are actually more mentally prepared for you to create your own trading strategy in this case. So some platforms that we have, right, for Poems 2.0, right, when you want to do your trading itself, we have basically you can actually do it through Poems in this case. So in Poems 2.0, we have the advanced order types that we have, whereby you can actually place your trades and also to see the charts in this case. So let me show you what we have over here. Hang on. So just to show with you basically the charting tools that we have. Okay. So if you actually go to the charts itself over here. Okay, hang on now. Let me just refresh it. Okay, let me just try to log in again from here. Oh. So if we actually look like, example like Euro USD, right? Just by typing this, right, we can actually look at the charts for Euro USD here. So when you click over here, so if you click over here itself, right, you can actually see the different charts that we have over here. So in this case, this actually illustrates the price movement between Euro and USD. Yeah, so over here, we can add all kinds of indicators as you want. If you are looking at EMA, you can select here, and you can actually look at basically each of the exponential moving averages. Likewise, you can look at further years, in this case up to 3 years itself. You can see that Euro has over time itself have been on the downtrend as compared to USD. So USD is appreciating against SGD until recently. until this month itself, it seems to go against the trend whereby USD seems to depreciate against euros due to the some of the interest rate changes that the US Federal Reserve has taken. Likewise, if you want to search for our FX CFD in this case, you can select under our view price here, CFD, and select here under FX over here. So this is when you can actually look at all our different currency pairs over here. So if I take example Euro, British Pound, we can select here. You can see that on this top right hand corner, we have the different kind of, okay, let me just expand. We have basically the trading bottle over here. So you can choose to buy and to sell. And over here, our system will be smart enough for you to calculate the minimum requirements that you need to place your orders. So in this case, because the price in the quoted currency is in British Pound, so it's actually quoted in the contract value is quoted in pounds in this case. So if I want to enter a position at 10, I will just click 10. It will be 90,000 British Pound, and 5% of it based on the FX rate will be actually base value will be 7,800 Sing dollars. So this is a minimum position you need to have in your cash in this case in order for you to take a short position of this contract, meaning longing British Pound, shorting the euros in this case. So by selecting order type, we have a limit order as well as the stop limit order as well, which you can place it over here, either the bid and ask, or it can be done in one trading platform. So in summary, what we have shown is basically what is FX CFD in this case. Then we talk about Forex. So we talk about CFD first before talking about Forex. Then we combine it together to tell you what is FX CFD about. The type of trading strategies we have in this case. That we also discuss about a bit on how you can actually consider when actually planning your own trading strategy, and the kind of trading discipline you need to have when you actually implement such strategies in this case, and also the kind of tools that we have in Points 2.0. So a bit of shout out that we have over here. We have these various CFD new account opening in this case, promotion that we have. So right now what we have is that if you actually open a new CFD account and you fund with us basically $5,000 within 2 weeks of account opening itself, you get to have first trade to be free, whereby when you actually place the order successfully, then we actually give you a rebate amounting to the commission of the trade that you actually place with us. You put in more than that, like 15,000 or 25,000 for within the first 2 weeks, and you fund it in it, then you will get respectively about 3 free trades as well as 5 free trades, etc. So to find out more, you can go to our PhillipCapital CFD promotions website. Next, we have actually this CFD frequent traders program. So we reward basically CFD traders who actually trade quite frequently with us. So in this case, if you trade more than with us, in this case, if you can more than $2,000 in a month, you can actually get $60 trading credits as well as special commissions for your Singapore, Malaysia, as well as the United States CFDs. So this feel free to check out our website, this Points platform promotion websites to know more. Likewise, if you have any referrals that you want to bring along, for example, if you after trading CFD and you think that your friends can actually benefit from our services, you can actually get your friends to join up, fill up a referral form. In this case, then after that, once your friend in this case makes a few trades, in this case, 3 successful trades with us within the 2 months of opening itself, both of you can actually get 150 Sing dollars worth of CFD trading credits. So this is actually to incentivize you to actually to get people to join on board with you. So up to 5 different friends, you got 5 different friends join you and place this amount of trades, then you get $750 worth of the CFD trading credits. So this is something that you can actually utilize to join us.
So feel free to talk to us. This is my email. If you have anything, just drop me an email. I'll try to answer to my best of my abilities. Yeah. So right now it's the FAQ session. So if you have any questions, you can just drop me basically just drop me an email from here. But not email, but drop me a text on this Q&A. Okay, so about this question, like since the Forex is 24 hours, what determines the day opening and pricing in this case? So in this case, if you actually look at the day open and day close, right? Because our trading hours is between 5 a.m. to 5 p.m. So that will actually entail the different prices in this case. So it's actually the trading price timing. Okay, so if I look at the chart in this case, so each of these timing itself, if you look at it, you don't see the actual time itself, but you based on the day, how high the price actually went up and how high the price actually went down. So each of the tickers in this case represents 1 day of the timing, which is between the 5 a.m. and 6 a.m. are respectively based on the daylight saving mode and the daylight non-daylight saving mode. So if you look at the day itself, right, you can see the timing itself is under the GMT +8, which is today's Singapore time in this case. Okay, any more questions from here? Okay, if not, thank you so much for actually joining us. Okay, got any questions, can feel free to drop the email over to us over here. Okay, just share. Yeah, so I'll just keep this screen open for about 3 minutes. If not, I'll just end the session.